Mark, thank you so much for joining me today in another episode of Making Risk Flow. I'm really excited having you as a guest, and yeah, we're looking forward to the conversation. Let's perhaps start with an overview of your current role and background.
Great, thanks, Juan. And good to be on the show and be here with you talking about this subject, which I'm very passionate about. I came into the industry about 15 years ago when I joined Brit and worked there for about 10 years in a variety of different roles, including being Chief Risk Officer for a while and Chief Financial Officer since 2015. So great experience in that broad different roles I played at Brit. And before that, I was a management consultant at McKinsey, and by training, I'm an actuary. So a bit of a different series of career steps on my journey.
And today, you lead Brit, so you lead Key as the CEO, right?
Correct. Yeah. So in 2020, we started thinking about a new business model, a digital challenger in the form of Key. I can go into some of the background in a minute, but when we formed Key, we decided to do it as a digital challenger and set it up as a standalone business, so a commercially viable standalone business with its own capital, with its own syndicate, with its own brand, own technology. And at that point, I was very excited about the prospects for Key. I still am, and was very happy to take on the role of CEO of Key in 2021 when we launched.
So I'm sure by now, everybody knows what Key is, but just for those who are less familiar or listening from the other side of the pond, what is Key? What does it make it unique?
Yeah, so Key is a very different business in Lloyd's. We have set ourselves out a little bit different in that we're follow only. So most other businesses in Lloyd's are leaders, what you'd think of as leaders who are pricing and structuring risk. We only follow business, so we are price takers, and we're there to fill the capacity that's needed for these large, complex placements that find their way to Lloyd's. But the main differentiator of Key is that we're a digital-first business, data-led, and we underwrite using algorithms. So we're trying to create a new kind of business, which is really oriented towards the future of the market as the market evolves into digital trading. And we thought it would be best to start Key really afresh, if you like. So we built Key within the Brit environment because we had access to Brit's intellectual property, if you like, Brit's data and underwriting know-how and so on. But then what we did is we took a clean sheet approach to the technology and built from scratch in a new and modern data first way. And the thing that gives us that's a real differentiator in the market is we can respond very, very quickly to a request from a broker on behalf of a client. So our current average response time to quote is about 5 seconds, which is pretty dramatically faster than other players in the market. And really our mission is to try and give brokers that follow capacity as seamlessly and efficiently as possible, as quickly as possible, so they can use our platform anytime, anywhere. They can access it across the globe. So a fundamental rethink of how business can be done in the market. I do think it's worth emphasizing that we're still an underwriter, and maybe we'll get into that in a bit more detail, but the algorithms we've built are underwriting on a per risk basis. They're just doing that using technology, which makes it very much faster than a sort of step-by-step manual process.
I think that's great that one of your focus or KPIs is responsiveness to brokers. But this is something that in other segments of the market, if you think obviously small commercial, mid-market, it's a real part of the DNA or the ambition of insurers. But typically in London market, you hear less about that, right? Because I guess historically, it's not been a priority or it's been more complicated to do. So you are one of the pioneers of really bringing some of that level of service into the London market space.
Yeah, I think it's a great point. And Lloyd's has been through kind of multiple iterations of trying to modernize and iterate the business model. We actually took inspiration from the blueprint strategy process that happened in 2019 and really focused on a digital data-led future for the market. So that was really the prompt for us, if you like, to start thinking about a digital first business and ultimately bring Key to market. And I think to your point, there were a lot of questions over, willingness, attitude of brokers to embrace new technology. And I'd say in the first few years, we've really proven that wrong. I think the market has really embraced the technology we've built. Just to give some examples, we've built a system which is now used by over 1,000 brokers in the market. And on an active, ongoing basis, we quoted on over 30,000 policies last year, and we wrote over $1 billion of premium. So it's not a small business. This is a major part of the market now, and embedded into a lot of brokers' daily lives and working habits. So I think the market has genuinely got the ability to evolve and iterate and innovate, and we're delighted with that. And one of the things we're trying to do is to really, our core business is the underwriting and the algorithm, but we've also built this technology platform, and we do see opportunities for reuse of that technology. Right. So we're working with some other underwriters to let them use our technology and offer digital follow capacity. So there are our capacity partners, and we're also working with, and to be specific, we've got Aspen and Travelers and QBE and Beasley all as capacity partners. So they're using our technology to offer digital follow capacity. And then on the broker side, we're also very open to partnerships as well. And this year, we've been working on a major partnership with Howden, who've really brought a fresh eyes to some of how they trade follow business, and we've helped them with some of our technology. So we're trying to see the market as an ecosystem and be a player in the market that can help others, as well as building technology for our own use.
And from a line of business perspective, how specialized are you in the lines of business you write?
We have our core products, and I'd say we cover, I think the products which are our core products, probably cover about 70% of the business that's placed in the London market. In the main property, casualty, specialty pillars. And really what we're looking for there are classes where there's sufficient data and sufficient scale to apply an algorithmic model. It is a bit different from lead underwriting, where each risk would be heavily researched and constructed on an individual basis, and then the underwriter would typically offer a large amount of capacity. So it's quite a concentrated strategy. For us, because we're more data driven, we're writing more of a spread portfolio and looking for scale in terms of the number of risks we're writing, and more of a follow type line size. So it's a bit of a different strategy, and scale matters in the products we write, but it's those typical property, casualty, specialty classes is our bread and butter.
You said two things that I kind of raised the question there. UPS, previously you mentioned that you still write on an individual risk level, right? And you've also mentioned that obviously you focus on lines of business where there's enough data. So your approach it's not really, or it might be portfolio underwriting. It's an individual risk basis, but with enough data that you can really analyze them individually, or is that the approach?
The way I think about that is our process would look somewhat similar to what an underwriter would do. So they would try to establish a price for the piece of business they're looking at. That would be based on the individual characteristics of that risk and the structure of the placement and so on. They would look at the quality and research that client, that insured that they're covering. They'd look at the risk information around that in their individual assets or the liabilities that are being covered. So there's very much a rich evaluation of the individual risk, the client, the policy. That's part of our process. But then you also have to understand how that individual risk fits into your overall portfolio. So we also have portfolio level controls, and we have aggregation aspects to our algorithm that very much look at our overall appetite for that segment or that location and what our in-force book represents. So a lot of underwriting is obviously about accumulation and risk management. So we've got those two lenses built into the algorithm that work together to come up with our capacity and our appetite for a risk. So I think those factors in that complex series of data-driven calculations, that's what we think of as underwriting at a per risk level. And I think that's really one of the major differentiators in our business models, our business model compared to other follow type business models or facility type models where it's more rules based rather than sophisticated individual risk underwriting. And then the other feature of our business is we wrap the individual risk underwriting in portfolio management activity before and after we see a risk. So we're constantly reviewing the renewing portfolio, the total portfolio, and we're seeing how that evolves through the course of a year. And because of a lot of our underwriting is done in the algorithm, actually a lot of our resources are freed up to have that more holistic view of risk and to monitor the performance and the build up of the portfolio.
And so you're looking at the underwriting individual risk, the marginal impact of that risk in the portfolio from an aggregation perspective, and from a price. So you, to some extent, you're a price taker, or do you actually price individual risks?
We establish a price, our view of price. So we have our own view of price, but we're a price taker in the market. So the market has set the price. That's what the leader has done with the broker. The broker selected the leader they want to place the business with. And so the price is essentially fixed when we see the business, but we are pricing every individual risk because we want to understand the pricing strength and we want to understand rate change and we want to understand how that fits relative to other risks in the portfolio. So when I say we're pricing the business, I mean that we're establishing a model price, if you like, for that individual contract.
Understood. And you mentioned earlier that 5-second turnaround time. So obviously most of it is automated, but I'm sure there's a percentage of risks that you still have, and that you want an underwriter to take a look at, or do you actually have underwriters physically looking at individual risk, or just on an exception basis?
We make effectively risk-based decisions on that. So we have different hierarchies for whether an underwriter looks at a risk or not. So it's very much as you'd expect. It's kind of the algorithm has parameters it can operate within. As the risks get larger and more complex, then there'd be exit routes where that would get referred into an underwriter and they would pick up the risk and review it and make the final decision on it, which we think of as kind of hybrid underwriting. So the algorithm and the human providing oversight. So there's a variety of different processes it goes through. I think it's one of the misnomers about a digital business is thinking of it as a kind of black box machine. Actually, it's not. It's a load of people, and there are people in Key who need to work with brokers and talk to brokers, and some of them are underwriters of various backgrounds and experts in their field. We have actuaries and portfolio managers who are monitoring the portfolio, and then we have a large engineering team, data science team. These are all the teams of people that we have in the business. They work together to create the product and to create the service that faces off into the market in terms of the overall proposition of Key.
So really it's the role of the underwriting when you're analyzing a given risk is by exception validating or steering, like the recommendation from the technology. How do you see that evolving? I mean, this is probably about predicting the future, right? Do you see like the percentage of risks that actually require an underwriter confirming the decision going down, or is your vision to keep it as is?
Oh no, I think that will go down over time. There are different reasons why we might have an underwriter involved, and normally it's because it's a larger exposure to our balance sheet, and we want to make sure that we have the right level of control over those. So that sort of higher complexity, higher scale risk is what we want to have more control over. I think over time the numbers will decrease, but I still think there'll be a role for a human to be overseeing the algorithm and looking at referrals in our business. The other thing is, I think there are, I mentioned earlier that higher data volumes, classes with higher data volumes are easier to train algorithms on, essentially. So over time, as we enhance data and gather more data, we can potentially convert more of the other classes and other areas of appetite into more algorithmic driven underwriting. So it's a journey. I think you start with the big high volume classes with small line size. That's the absolute best place to start with an algorithm, and then over time we increase the use of algorithms in the other areas.
One of the things, obviously, you're constantly balancing your technology, data science skill sets with obviously your underwriting expertise, not just, but as you said, not just to look at individual risk, look at portfolios, think about balancing the portfolio, renewals. How do you, I think this is one of the things which often is most difficult, is like, how do you structure and manage an organization where those two things need to be very coupled, but obviously they are completely different skill sets?
It's a great question, and I think the two, there's many different skill sets in the organization. So, but I think it's largely characterized normally as the sort of insurance skill set and the technology skill set. It's not as simple as that. It's much more nuanced and much richer than that. We've tried to take a sort of clean approach to this as a business, and we've tried to build up effectively a unique talent pool that has the required cross-functional skill set. It's quite, to your question, it's quite a hard exercise to constantly optimize that. And there are different ways of working across different groups. There are different experience sets. And in those two areas, the underwriting, insurance, and the technology skill set, they tend not to overlap very much. So you tend to have people who are 100% insurance, 0% technology, or 100% technology, 0% insurance. We've deliberately tried to hire technology people from other industries where they've had much more experience of working with algorithms and the sort of data science that we're using. So to a degree, we've deliberately brought people in who don't have that experience because they've got a better skill set in the actual technology area that you want to import the skills for. And we also have a general cultural view that we can learn more from experts who've done it before than, trying to stick to that traditional insurance mindset of we kind of know best. So we've tried to bring in new skills and new experience into the business. And what that means is you have to spend a lot of time, you have to put a lot of work into the meshing together and the collaboration and the interaction between the different teams. There are tons of existing ways of doing that. We have a product function which helps us orchestrate cross-functional squads and manage our roadmaps. That's very much a tried and tested way of managing these cross-functional teams. We're quite a mission-driven, mission-oriented business, so we have a big vision for how to try to change the market and try to move. Our passion really is to deploy technology and try to improve how the market operates. And I think that does bring together all of the different people. So typically when we're hiring, whether we're hiring from insurance or whether we're hiring from technology sectors, we're attracting people who believe in that mission, who share that overall goal. So, to me, it's a combination of having that right mindset, having that right overall shared mission and values, but then fusing it together with the right processes on a daily basis. We've seen that happen time and again, where we've got underwriters, be it in a D&O class of business, who've got deep subject matter expertise on the data sets that are available, the right risk factors that are used in that underwriting evaluation. And we pair them up with technology professionals who can pull in the third-party data and process it through our databases and then surface it in the algorithm to generate a stronger underwriting signal in that particular use case. So it's really about getting those people working together as seamlessly as possible.
And did you find, well, one of the things that it's still a bit surprising, but still happens, I mean, I've spoken about this with many insurers, is it's often difficult for a carrier to decide whether something is a good risk or it's not a good risk. I mean, we would always have thought that is what insurance does, so we should be able to do that. But it is much more subjective than you think, only at the shallow level. To what extent do you enable those conversations between the product team, the tech team, and your underwriters to identify, okay, this is how we're gonna, I mean, at the back of whatever analysis you do, Is it easy to get to that level where you can say, okay, well, this was a good risk, or this cohort of risks are profitable or not?
I get you've hit on another major differentiator of our business model, I think, which is that we're trying to be unbiased and data driven. So I agree with your statement that in the wider world, there's a lot of judgment and subjectivity around an individual risk. Essentially, our model deliberately ignores that, and we try to make unbiased, data-driven decisions as far as possible on every occasion. So we've trained our models, our machine learning models are trained on a historic data set, which contains the claims information, the exposure information, the client information that we've seen as actual real life experience through different parts of the cycle. And we're using that to predict which risks are going to perform better in the future. So we're trying to avoid too much of that subjectivity and rely on the data to produce a high quality portfolio. Again, if you come back to the difference between lead and follow, what we're not trying to do is write a small number of very significant, very, very large exposures. We're trying to write a higher number of smaller exposures. And what we're doing is then constantly testing and learning and refining with our algorithm and with our underwriting. So it's becoming more and more sophisticated, and we can take into account more risk factors over time. So it's a bit of a different strategy, but we're trying to build in this unbiased, data-driven approach, and that's pretty fundamental to how we operate, because we get data from the brokers, we push data through a model, and that derives a line size. So it is quite different from those more human-led decisions where it could be driven by information that the brokers told you in a meeting, or something you've read that is particularly pertinent to that risk in the Financial Times in the morning. Who knows what factors are taken into account. Ours is different from that.
So is it fair to say the kind of the process you've gone through? I'm just playing back what I've heard, but see if I got it correct. So I assume you started by identifying what are profitable risks or unprofitable risks. Then obviously, so to be able to do the risk selection for new risks, you would have had to identify what are the characteristics. So what are the risk characteristics that correlate with the profitability that up front? And just to make it up, right? It could be it's for certain line of businesses, these industry classifications with this revenue, this exposure, whatever it is. So there's a first step of profitability of the risk. There's a second step of what are the risk characteristics that correlate with the profitability, and that is how your models then do the risk selection for new risks. Is it a good representation? Or I'm not trying to get into obviously your secret sauce, but just at a high level, is that a good summary or not?
It's not a bad summary. It's a bit more complex than that, but yes, it's effectively a machine learning multivariate model that would take into account those characteristics and considerations using our historic data set. So yeah, you summarized it pretty well there. I think what I'm trying to say is we have built a system and a business model. I think the business model and the system working together are really quite powerful, because we're able to offer a uniquely efficient business model and service model to the brokers through the fact that we're data driven and we're technology driven means that we're very, very fast and we're very easy to use. And then we use that same data, which is a core part of our value proposition to the broker, to using the advanced data science and machine learning to produce a stable and profitable underwriting result. And we do that on a spread basis because we're efficient and we can operate across a large number of risks. And that also means that our models are more predictive because we're writing a larger portfolio in terms of risk count. So it's not just about the data science, it's also about the business model and how it's sort of layered together.
That makes sense. And when you look back at the last 5-10 years building Key, as you perfectly said right now, there's a component of technology, the business model, underwriting, rigor. What would you say has been the hardest bit of building key? I mean, also the distribution, right? Having access to was like, what would you say has been the hardest?
Bringing in the talent, like finding the talent and bringing it into the industry has been challenging because, Key at the start was an unknown brand, and we had to build that reputation with the market to attract the right talent. So that's been pretty tough. I think being different isn't always easy. We're very different to the rest of the players in the market, and at times that feels pretty lonely and pretty challenging. So it's not easy to do things differently, and you have to really be committed to the cause and to the mission and vision. So we've always been focused on the differences of Key, and people love talking about the differences of Key, but they do also mean that we sometimes come under pressure from other parts of the market. So it's those kind of things have been difficult. I think we've been very fortunate in terms of timing of the launch. The market conditions we launched into were pretty accommodative to us. But then on the flip side, we were building a new business from our homes in lockdown and during COVID, and that was equally a pretty challenging time to innovate and start something new. So as I think back, those sort of people theme, the being different theme, and probably that launch phase where we were building a new business remotely were all big challenges we've encountered. I think part of me says actually the harder it is, the harder it is to repeat as well. So it's maybe part of what's an advantage for us today is it's pretty difficult to do those things.
Well, you've definitely done something right when, like, to your point about being different, Key is one of those names that everybody talks about, right? It's like, okay, we want to do. I almost think about it the same way when you say I'm Googling something and you use the word Google, right? When people think about the follow the tech-driven syndicate, they always think like we want to build something like Key, right? So I think the fact that you've created that in, as you say, in 5-6 years is absolutely outstanding. What is next in terms of like? It sounds like you've built a billion-dollar business. What are the challenges and what's the aspiration for the next 5 years?
I'm all about execution. I think what we've got to be focused on is our core business. So continuing to evolve and develop the algorithm, which is really at the heart of the business, and the broker proposition. So why do brokers want to use Key? How do brokers access Key? How do we make that easier and faster than it's ever been before? So we're pretty driven by those factors and making sure that we're focused on sustaining the momentum and sustaining the business and improving the business that we've built. So that's really the core focus. We'd love to see more brokers use Key for more placing more risks, and that's essentially what we're here to do. I think beyond that, we are really excited about the technology partnerships, and I mentioned this earlier. Whether it's with a carrier or whether it's with a broker, we think we've built some really good technology, which we're very happy to partner with other people to share, to allow them to write digital follow or to allow them to make their business even more efficient. So for me, it's about if people want to partner on the technology, how do we find those opportunities and how do we expand our business in that way? We've built a core system, a core platform, a core underwriting algorithm, which are, we think, pretty unique and pretty special, and we think other people will want to come on that journey with us. So partnership is really the other piece that we're focused on to scale the use of the technology that we've built, and that's where we see a major opportunity over the next few years.
And when you say increase your broker distribution network, is it about just developing more partnerships with brokers, or is there something in terms of the actual proposition that you think will unlock the next set of brokers to partner with?
Oh no, I mean it's with the brokers that we're already partnering with. So I think it's about working with them as they develop their digital strategies and evolve their business model. So for me, we're going into a period over the next 3 to 5 years where I think the pace of change is going to accelerate, and brokers are going to be really on the front foot in terms of how they use technology in their business model. And we see that as a great opportunity for us to work with them. We're we have some great conversations today that I think that the experience for the brokers using our platform today is very good. But those placing mechanisms will change, I suspect, over the coming few years, and we want to be ready to work with our brokers to embrace that change and help them on that change. So it's not kind of anything new or different in that sense. It's more of the same, but it's that constant evolution and keeping pace with the change that I think is going to happen in the market and in how business is placed across the business lines that we operate in.
Yeah, well, that actually sounds very, very aligned to the name of this podcast of Making Risk Flow. I think what you're saying is you've got a tech-driven underwriting platform that the more your partners can leverage in a more digital way, the more it will amplify your growth, right? And at the end, it's like how do you actually, going back to the theme of the podcast, right, is how does the risk flow in more digital way from the broker to some of your capacity partners?
Yeah, and exactly that. And that, like, how do we enable those trades to happen more seamlessly? We want to work with our brokers to make that happen. We have a $500 million balance sheet. We raised $500 million. It's more than $500 million now. You'd be pleased to hear. But the balance sheet business that we have and the technology that we have, we think can be really valuable to brokers. And we're an underwriting business with some technology, and we think we'd love to be even more important partners to the brokers as they build out their own digital strategy. So that's really the focus for us. And if the technology can be useful to other carriers, then that's another good opportunity for us to partner. So it's a sort of partnership-minded business right from the start, where we were very happy working with Google and with UCL, and we worked with Brit and Fairfax to launch the business. We've always had that culture and mindset of let's try and find a kind of win-win opportunity. Let's find experts who know more than we do, or have different relationships to those we do, and let's partner together and find some wins. I think it's a bit of a back to your comment earlier, part of our DNA that we like working with people to create value. That's kind of part of what we try and find as opportunities.
And I really like how you capture the kind of the pillars of your next stage of growth around doubling down on what you're doing already and really focusing on partnerships and enabling the whole industry, right? I think that is something that rarely you hear other players talk about, which is like by enabling brokers and other partners, you will all grow together. And I think that, yeah. Mark, it's
the mindset. Absolutely. And I think we don't want to like hide our stuff in the corner. Our technology is, we think it's really good and we're proud of it and we'd like people to use it. And if it's a benefit to them, then that'd be great. And at the core of it, we're an underwriting business. So and that's really important because we're going to keep investing in our underwriting technology, but that there are also different pieces of the technology that have different uses, and we're very happy to explore those with people. So it feels like a natural evolution of the business. Hopefully we can continue on that journey.
Absolutely. Mark, it's been fantastic to catch up and hear more about your history, how you think about your strategy and kind of your future. Thank you so much for joining me.
Great. It's been a pleasure. Thanks for having me on.